Decoding the new tax code for real estate investors. That's the topic for today's episode. And without further ado, let's dive in. Hello everyone and welcome back to today's episode. So today it's all about taxes. I actually have a special guest here in today's episode. This is Jennifer Kirkland. Jennifer,
Hello.
welcome.
Thank you for having me, Lucy.
So Jennifer is actually a great friend of mine. We go back in the days when we were in college. She also happens to be my accountant of many years. And she has graciously agreed to come in and film a couple of info sessions just so you as a real estate investor can take the most benefit out of the tax code going forward. So without further ado, let's just dive in and open the floor to Jennifer so she can share with us what she knows best.
So the new tax code has had everyone in a frenzy. Like, is it a benefit to me? Is it not a benefit to me? But for real estate investors, it's a huge benefit. The days, Lucy, of having this big house that I'm going to live in and just living in, and that's going to be my biggest asset, and I'm going to get to deduct all my real estate taxes and mortgage interest is not possible anymore unless you're a real estate investor. One of the major things that you can take away from this new tax law is that now for state and local taxes that you pay, depending on what jurisdiction you live in and what state you live in, is that they've capped it at $10,000. Now, if you're in a high taxing state, we live in New York City, so we have to pay city tax, state tax, and now we have to pay property tax, but we can't even deduct all of our taxes anymore. But if you're a real estate investor and you have a second property or you have a two-family, now you can deduct the whole thing and you can avoid that $10,000 cap. So now we're in an age now where it's almost, this new tax law is forced, this is what I'm taking away. It's forcing people to have their own business, work for themselves, and it's forcing people to invest in real estate.
So basically, in essence, this is the year for you. So take full advantage of the real estate code and the availability of information that we're providing you through this channel just so you can start investing and achieve that financial freedom that you're seeking for. So Jennifer, what would you say are the major things that a real investor should actually start looking forward to? So someone who's new coming in and they want to start investing in real estate for the first time, what are some of the key components that they should start kind of like thinking about so they can be ready when they start filing for their taxes as an investor?
So I always tell people, everyone looks at the big house. Maybe not start so big. This is just my opinion. Maybe, okay, let's say you have space in your home or you wanted to start renting out your space or you see a property that you want. Really start saving your money together. One of the things is, let's say if you have, like when people started renting out rooms and things like that.
Like Airbnb?
Like Airbnb.
Okay.
Or I've even seen people have become so creative that they're actually doing this. Now, let's say if you're in a house and you're like, hey, I just got this house. I can't afford to now get another property and move. Maybe some creative ways that you can go around this $10,000 cap is that you're using part of your house. So now on your tax return, you can actually split your house that you already live in. Maybe if you have a basement, I guess every legal rules in each state apply. Keep that in mind. But you could start writing off your utilities, your heating costs, your insurance, all of these things onto the Schedule E and not be stuck to that $10,000 cap just to start.
So in other words, a write-off, it's basically a deduction that they can take on their taxes as either business or real estate investors?
Yes, as an expense. Let's say you don't have a two-family yet. The goal is to eventually get a rental property. But let's say you don't have it yet and you're just starting out and you're like, man, I didn't see this video. I got my home. I'm thinking I'm supposed to write off my stuff. And now you're telling me about a new tax code is not even allowing me to write off my stuff. Let's say you need help with the mortgage. Now you have someone coming in possibly paying off part of your mortgage. And now in order to keep that mortgage, you can sort of amortize the expenses related to that. So for example, if you have to pay for heat, part of your heating bill now can get deductible. If you was living in it by yourself, your personal heating bill is not tax deductible. But now because you have a rental income, you can deduct your heating bill. And one of the biggest tax things you could start doing while you're in your home is depreciation. You could start depreciating your house. So now that you're getting rental income, of course you have to report the income that you're getting. Keep that in mind. But you can't just have a bunch of expenses on there and no income. But my thing is you report the income that you're getting from your rent. Now you're deducting your mortgage interest off of it. You're deducting part of it off of it in the space that you're using. Let's say you have light. You have to provide them with light, whatever your light bill is. You can amortize your light bill, your water bill, your gas bill, all of the costs that it takes to function and someone to live in that home. And the biggest thing is, let's say you say, well, wait, after all I amortize that, I still have income. One of the biggest, and some people say, one of the biggest tax advantages is the depreciation.
So Jennifer, for those who don't know, what exactly is an amortization or depreciation? Maybe you can share a little bit about that for those who are actually new to the subject of taxation and stuff like that.
Let me give a simpler example. So let's say you have a car, and let's say you had the car for 10 years, and the car cost you, I'm going to say a crazy number, $100,000 or home $100,000, and you had 10 years for the life of this car. Every year, your car will be depreciation 10,000. It'll be amortized over 10 years, 10,000, 10,000, 10,000 per year. So when 2 years go by and you drive the car is not as strong, your battery is not as strong, your engine is not as strong as it was 2 years ago. The longer you go out, the lower the value is of your car. So your car is not, as soon as you drive it off the lot, well, technically when you drive it off the lot, it's depreciated ridiculously. You're actually ripped off. But but when you drive it off the lot, just for example sense, your home is not the same condition as it was when it was brand new. The roof gets rusty. All of these things the IRS understands and factors in. And as you get to enjoy that benefit of every year, the IRS law says for your home is over 27.5 years, but every year, just for simplicity's sake, we'll say 10 years, you get to take 10,000, 10,000, 10,000, 10,000 right off every single year, and you really didn't spend $10,000 out of your money.
Let's say, for example, I have a house that costs $100,000. So what you're saying is, you'll take that 100,000, divide it by 27.5, and that will be the deduction for them on that particular year.
Yes.
Okay.
Correct.
So basically,
minus the land.
Minus the land.
Because land is not depreciable.
For those who think that this might sound a little contradictory, what Jennifer's saying is your house is not depreciating in value, because houses do appreciate depending on the area that you're in, the circumstances. But in terms of taxes for the IRS, when you're taking any deductions for business expense, declaring your income, you can actually take that expense, that depreciation in your real estate property as an expense that's going to help you keep money in your pocket, because that's basically what the whole idea of the rich dad, poor dad concept is. Not so much how much you make, but it's more about how much you keep in your pocket, right?
Correct.
So what you just shared typically works well for people who have rentals as a real estate investment vehicle. But what about those who, let's say, for example, do house flipping or wholesaling? So for those who don't know what wholesaling means, you just basically go and you assign a property from one person to another. So you're kind of like the middle person in between. So how does that impact them on a tax standpoint? Because technically you don't really own the property. You basically go out, you find the house as a merchandise, and then you sell it. You resell it to another investor who's willing to pay a little bit more for that house. And you as a middle person, you make a profit out of it. So how does that profit factors in with you as a real estate investor?
That's when they're going to get a bit hurt, because they can't depreciate something that they don't own. And the goal is, it's funny because everyone has their own niche. So if their goal is to get a retainer fee, that's their business. That is their business. I mean, I'm sure they can write off the cost that it took them to research the home and all that other stuff, but they don't really own the home. They're getting their finder's fee.
So you were saying that from a real estate standpoint, there's no deduction from that end, but there's still the caveat that they can deduct those business expenses like driving around for dollars, money that was spent in gas, the money that you spent on paying your utility bills like the internet, or even the lighting, the electricity that you use to put your computer back on, just so you can do that. Okay.
Yes, yes. So you do get that benefit. I do think so I can give myself as an example. Having your own business is a great advantage, because you do get to take advantages of write-offs that the time you spent, investing and wholesaling and trying to own your home. But one of the best tax ways is if you can get a wholesale property for yourself and then you can utilize, so it will be at a cheaper rate, so your depreciation expense will be lower the cheaper you get your home. But then you can utilize, if you're having a more long-term asset. I'll give you an example. So let's say you do get the home and you own it and you want to flip it and sell it right away. Now it's become a business, and your tax is going to be impacted by it higher because you'll have a short-term capital gains tax, which is pretty high. It depends on each person's individual tax structure. But if you keep the house for more than a year, if you become and you sell it, it is at a lower capital gains tax.
So short-term capital gains is any gain that you acquire in a period of 12 months or less, right?
Correct.
And then long-term is anything 12 months or above. So if I'm understanding correctly, if you happen to acquire a property, let's say you flip it or you wholesale it, and if you sell it at a profit within that 12-month period of time, your tax rate is actually going to get higher. It's going to be higher as if you were to hold that property for over 12 months, let's say 12 months and 1 day.
Yes.
Then as soon as it hit 12 months and 1 day and you sell it at a profit, the tax rate, it's going to be how much lower?
It's going to be significantly lower, almost like maybe possibly, almost 10% lower. And everyone's tax rate is different, so I don't want to quote rates. And you said you told me this.
It depends on the state,
what your
right?
income, your state, what your income is, how many children you have. But that also goes with stock as well. So even if you own stock, that same scenario goes.
Mm-hmm.
But from the real estate investment standpoint, there is one way around getting around the entire tax.
And how is that?
It's called 1031, like-kind exchange. So if you were able to find it, well, it's not getting around it, it's deferring the tax. So, but you can keep deferring. It pretty much means, let's say you get this house, you see a buyer, and it just so happens to be that you want to sell it right away. Now, if you were able to find another house similar to that house, that gain gets transferred over there, and essentially you're not paying any tax.
I've heard about a 1031 exchange. I have not done it myself, but I think in essence what you're trying to say is, let's say for example, I have a house that it's worth $100,000, right?
Yes.
And I want to sell it, but if I do sell it, then I'm going to have to pay taxes on the gains that I've made, and even give back the depreciation expense that I've taken advantage of over the years. But if I sell that house and I find, let's say, another real estate property that's worth either the same or a higher amount, let's say $250,000, and I sell it and I take those gains and I put it either as a down payment or acquire the other property at the same or higher value, then I don't have to pay any taxes off of it, right?
Correct, because you used the money. It's not like you kept it in your pocket and was like, woo, I made money. It's you used the money into another asset.
All right, so that's great. Now we know a little bit about how taxes play a role into wholesaling. So what about flipping? So I buy a house for $50,000, I renovate it, make it beautiful, and all of a sudden I want to sell it for $100,000. So how does the capital gain factors in this, since typically house flippings are done in a period of less than 1 year? So how does that work?
So all the costs that you put into building the house, all of that can be a write-off along with before you sell the house. So it's literally all the costs that it took, and that question could be a bit technical, and this is why you may need to hire a CPA, because it depends on what did you do. So like your original example of you bought a house for $50,000, you want to double it and sell it for $100,000, but you're going to put $20,000 invested into it. It depends on what did you invest on. Did you have painter's paint? Then that's like an automatic expense. Did you have to fix a roof? So now you have to add that onto the cost and capitalize it. But essentially, if you do it in less than a year, you are going to be subject, very similar to wholesaling, to a higher capital gains tax rate because you own it now, because you're subject to a higher capital tax rate. But if you take advantage of things like 1031 like-kind exchanges, you possibly can defer it and not pay tax at all.
Right. So this is why it's very important to be mindful of taxes and to have someone who's actually qualified to work with you, like Jennifer. Not every accountant And this is not to take away from the value that your accountant has to offer, but your accountant has to be investor friendly. They have to be expert and working with investors, understanding the tax code and how that's going to factor in your role and your business as a real estate investor, because you want to keep as much money in your pocket by taking advantage of what the code has to offer. So our next question, I've actually had a lot of people reach out to me asking about having a real estate property that they can also reside in. So like, for example, in New York, as you all know, the properties are pretty expensive over here. So it's almost like impossible to make a gain out of it if you were to, let's say, buy a 1 or 2 family house and just simply rent it out. It's just the price of the mortgage payments versus how much you can get out of it and rent almost never pays off. But some people have actually gotten a little creative, and they've asked, well, how does it work if, let's say, I buy a 2-family with an FHA loan? And for those who don't know what an FHA loan is, here's a link that you can actually refer to and learn a little bit about that. But for those people who want to take advantage of the FHA loan, put as little as 3.5% down, live on one side and rent the other, how does that help them or affect them in terms of depreciation, deducting some of the expenses like the utilities and stuff like that? How does that work for them?
Well, if you do qualify for an HFA loan, I guess the benefit is that you're keeping a lot of your cash if you have it, and you're only putting 3.5%. But the beauty is that with your mortgage interest, you get to split it. If you do have a 2-family, you get to split your home. The flip side of it is that the benefit is they get to write part of their real estate taxes off, half off. If they have a 2-family, half of the home belongs to the real estate taxes is being written off, and the mortgage interest, and half of their in things that they couldn't write off if they lived by themselves, like their insurance and all that other stuff. And back to your question with the depreciation is the same because the cost of the home is still the cost of the home. It's still your home. You still have title. Your name is on the deed. So you get the benefit of half of the cost of your home now being depreciated since you live in the other half.
Okay, so it's like almost the best of both worlds, right? So you're getting benefits that typically real investors or businesses will get, but at the same time, because you live in it, you get to apply some of it to your advantage,
yes.
Right?
Yes. My takeaway is, as a CPA, is that this new tax law really is to promote people to become real estate investors or become more savvy in taking full advantage of their home and getting the best possible deductions for it.
Great. So are there any differences in the deductions that they can take in the old tax code versus the new one?
Well, my takeaway from the new tax code is the real estate investor is getting all the benefits. They used to get the benefits in the past, but now they're really getting it. The average person who wants to now, just live in the home and just want to live with my family. I don't want to invest. I don't want to think of these creative ways. They're almost being penalized. They're almost kind of like forced to kind of think of creative ways that they can make income and take deductions now. And I think this new tax code is really for real estate investors and people who own their own businesses. So it's definitely a very creative way that's almost encouraging doing some small investing so you can take advantage of the tax opportunities for the property that you've purchased.
So thank you for sharing. That was actually very informative. So the next question is going to be all about interest, right? So I've had people reach out to me asking me about the interest that you pay towards your mortgage and the interest that you pay towards the business credit card. Not personal, but business. So we're wondering how actually that plays a role here. Like, are they deductible? Are they not?
Personal credit card interest is not deductible, and I suggest that as you grow and develop your personal credit, maybe look forward to getting business credit, because that is deductible because it is with your business. But your personal shopping sprees, the interest that you pay for being late or not paying it on time, is not tax deductible, but business interest is. So if you have a business loan or you have a business credit card and you had expenses that you had to buy to finance things that you use to flip your home, or the investment in the property, if you're wholesaling, whatever, that interest is tax deductible.
And same thing for the mortgage, right?
Yes. So the mortgage interest on any type of property, even if it's for yourself, you'll get something from their bank called a 1098 interest statement, and it'll be from your mortgage company, and it's reported to the IRS, and you will file that with your tax return. And depending on how you utilize your home, you'll take advantage of that when you work with your CPA.
Okay, okay. And what about expenses like your insurance, right? So you buy insurance to protect your home from liabilities, from any natural disasters. How does that factor in as a real estate investor, and maybe even as a person who wants to, buy insurance for their own home? Like how does that play into the
So if you're
taxes?
buying it for your own home and you're doing nothing with it, then no. But if you are, renting out a portion of your space, you can deduct a part of it. But if it's a complete rental, it's 100% tax deductible insuring your home. So all of it's a write-off. So if you're living in the home and you're starting to see that this new tax law is making you think of ways that you can mitigate your tax risk and just grow your real estate, then yes, on your mortgage interest, you can deduct a portion of it related to how your property is set up. Your two-family, maybe you could split it in half, depending on how it's set up. But if you are a full-blown real estate investor, you have a full-blown rental property, all of the insurance is tax deductible.
See, there are great benefits to the tax code for real estate investors. And again, the examples that Jennifer is sharing with you are more for illustration purposes. If you have a home where you're residing in, but then you're renting the other half and you want to take advantage of the depreciation and the deductions, make sure please to work with an accountant. This is not a do-it-yourself kind of thing. That's why you have to go and work with people who are specialized, because they are very familiar with the rules, with the laws, and they're there to help you stay away from trouble. Okay, Jennifer, so thank you for sharing all those tips. And now you might probably be wondering, why Jennifer and not any other accountant out there? So the reason why I chose Jennifer, and I've always been working with Jennifer for the past, I don't know how many years, but Jennifer is actually a real estate investor herself. So she owns her rentals, and she's been taking full advantage of what the tax law has to offer. And so I'll let her talk to you or share with you a little bit about her experience as an investor and how she actually applies the benefits of the tax code.
So my name is Jennifer, again, Jennifer Kirkland. I've been a CPA for 9 years. I'm also the first African-American woman to graduate from NYU Law School's first master's program in tax law. And I'm also an EA. So I'm a CPA licensed in New York. So you may have a CPA in different states that's licensed, but I'm also an enrolled agent. So I'm licensed everywhere to help you with your tax return. But as Lucy said, I'm also a real estate investor. So I know firsthand the benefits of utilizing the tax code to work in your benefit and taking full advantage of your depreciation and all your tax deductions that you have in your home. So definitely, if reach out to your own CPA if you have one already, or I can definitely assist you at Jennifer@mytaxologist.com. And I'm sure Lucy will put the link in.
Yes, I will definitely put the link down below so you can have access to her. So now that we have learned a little bit about what the tax code has to offer, her expertise, and how you can actually apply some of that to your real estate business, whether you're a flipper or wholesaler or even a long-term rental holder like we are. How about you share a little bit about yourself? How did you actually wind down in this journey doing taxes and where you are today, basically?
So mine is very touching, a bit deep story. Unfortunately, my father passed away when I was 14, and my mom was a stay-at-home mom, and she took care of her girls, my sisters. And at that time, my dad was a janitor for Hunter's College, and he was a UPS truck driver. And when I was a little girl, I remember when he was alive, he had a massive heart attack, totally unexpected. And my mom was home with her girls, and she wasn't managing the finances. And my dad always said before he passed away, you make money 3 ways. He said you make it with your beauty, your mind, or your labor, your hard work labor. And I was just like, oh my God, like that stuck with me even since I was 14, that, okay, my dad didn't want me to do it through beauty. He's like, I hope you do it through your mind. You go to school, you go this route. But then the part that stuck out to me was that he did work so hard. And so I remember when my dad passed away, I told my mom, I'm going to save money. I don't want new clothes for school. I want to help you. And one day I'm going to, have real estate and buy you a house, and I was 14 at the time. And so as I was working, I was just like, this is tough. the whole traditional way of learning, of just going to school and working a job for, you know, until you get a gold watch or whatever, it's totally have changed. I mean, there's been massive layoffs, and then if you can find a way to bring in passive income in your house, and what passive income is, when you close your eyes, money is still coming to you. So that's the best way I could describe it, is that, you know, you can have rental income coming to you where you can take advantage of tax deductions. You can get tax less. Passive income is tax less than earned income, your work day-to-day advantage. I was like, this is the way you can take care of it. So that's what sparked the interest. It's like, how can I utilize my own wisdom in this tax law to kind of make it work for me and mitigate my tax risks, not avoid paying any taxes, but
because that would be illegal.
That would be illegal. But to think smart of how you're working. Look at your, I would say, Jay, look at your W-2, and you look at box 2, you'll see just box 2 alone. I'm not even mentioning Social Security taxes and state, depending on what state you live in. But you look at box 2 alone, you're like, man, they've taken all my money. So
yeah,
I think this is the age of, with the encouragement of the new tax law, is ways of thinking of business ideas or real estate investing ideas to, you know, compensate that gap. And one of the things that I do, if you are in New York City, I volunteer for the Small Business Association. And that, Lucy, is one of the most rewarding things ever, because you get to see so many people's dreams in their hands. Just something a little bit outside of real estate. You meet people from all over who have their creative business idea, and now the tax law truly encourages that. And I just want to thank you, Lucy, for having me here, because as much as we talk about passive income and things of way to save money, I am not the most, this is my first time on YouTube.
Basically, what she was telling me is that she was doing all of these volunteer events, and it was so rewarding, and people, like, she feels that she can actually make a difference in people's life. People wondering about the tax law, like, how do I make this? How do I stay out of trouble? Because you will want to do this right? Yep. And in her mind, she was thinking, oh, how great would it be if, other than just helping people in New York and New York State, what if I get the chance or the opportunity to actually inform a much bigger audience, people like you who are watching right now, and help everybody. And it was kind of funny how we were kind of like in sync, because just as she was thinking about that, I reached out to her and say, hey, would you like to be a part of my YouTube channel? Because I wanted to do an episode on taxes and inform real estate investors and what they should be on the lookout for. And you graciously agreed, because you're like, oh my God, this is perfect. And now I can inform people outside of New York. It's not just New York, but now it's whoever can tap into the channel and learn about what Jennifer has to offer in taxes.
This is my first time on your channel. This is my first time on YouTube, and I'm so happy that you let me, you know, come on your platform and be able to do this. So this has truly been an honor, even a blessing. So I'm definitely honored to be able to give back and help you guys, and hopefully, you know, save money and start to think of creative ways to make money while saving in taxes.
And that's great, Jennifer. So thank you so much for sharing your tips with us today. Guys, if you have any questions or concerns, her contact information is going to be down in the description below. So feel free to send her an email, ask her questions. She'll be more than happy to help out. And if you find this information valuable, feel free to share the love to someone who might find the need to learn about the tax code. And as always, don't forget to subscribe or hit the like button below. And without further ado, we'll see you next time. Take care. Bye-bye.